Hello, Oak Bloke here, and this is an article on a new idea called Prospex Energy. This is going to be published on my Substack in the next couple of days, and this is so you're seeing it first. So this is available at my, or will be available at my Substack, which is theoakbloke.substack.com. And what I'm going to do in this article is talk about Prospex Energy, talk about its history a little bit, about where it is today, and then where it potentially will be in the next couple of years. So I have a couple of parts to it. I'm also going to just compare and contrast it with a couple of other companies of a similar size. So Prospex being 19.7 million market cap. And I'm going to just make some comparisons to other companies of a similar size and activity that I've written about recently. So Mast Energy being one, that's a 21.2 million market cap, and just incidentally, you can see has rapidly increased in share price. So you could have bought it for tuppence halfpenny back here, and today it's at £1 60, and still going strong. So we'll just make a couple of comparative thoughts around the wisdom of spending 21.2 million here versus 19.7 million there, or also comparing Chariot, so 22.4 million. So all three of them are kind of doing the same thing. Not exactly the same thing, but we'll talk about that. And I just wanted to kind of give some thoughts around that. None of this is advice. This is all just my own personal opinion. I'm not connected to any of these companies, and you make your own investment decisions. So Prospex. So Prospex, you can see a Spanish flag there in the background and a gas well, so that gives you a clue. So it's an investment company focused on European gas and power projects. It develops natural gas projects. So it's not an explorer per se. It takes existing projects and buys them and develops them. So in terms of what it currently holds today, is that it's got onshore. I mean, it does say that it will consider offshore, but it doesn't have any. So everything's onshore, and it's looking for what it describes as high impact onshore, and currently has operations in Spain, Italy, and Poland. Okay, so it's all about sort of working with existing working hydrocarbon systems, and these are the names of its different gas fields. Okay, so they've actually got onshore producing wells in southern Spain as well as in Tuscany, Italy, or Emilia Romagna, technically. So you can see the locations of its different projects here in this little diagram. So Emilia Romagna is this one here, which is Selva Malvezzi, which means the jungle of ill repute. I think it is the I did sort of write it down here. There you go, Bad Mannered Jungle, Bad Mannered Jungle, which is the most bizarre name for a gas project ever invented. But hey ho, there's also then Viura, which they bought earlier this year. There's then Romeril 1, 2, and 3. So Romeril is in southern Spain, and there's another one down here called Tesorillo, which is an exploration. This isn't a producer producing, and it also here we have applications in southern Poland. So this is on the sort of Slovakia border between Poland and Slovakia. Again, it's applications for the development. So both of these are exploration projects. The other three are all producing assets. Now, it gets even more complicated, or maybe not complicated, in as much as well, this supplies gas to the grid, whereas this one doesn't, or doesn't today. Romeril actually has its own electricity generator, so it essentially the gas feeds into the production, the electricity production plant, the gas turbine, It burns the gas and turns it to electricity. And then it also has some other bits and pieces like solar panels on the roof of the facility that also generate electricity. So what its business model is to sell the electricity into the Spanish grid, but of course it can take advantage of the ability to sell that gas, or so start again, sell that electricity at a time of its choosing, so it can switch itself on so in that respect, it's kind of very similar to Mast, because that's Mast's strategy. Big difference though is that Mast buys the gas, burns the gas, turns it into electricity, using what's called gas peaker plants. So this is kind of where at this project, that's what Prospex are also doing, and can sell it at times when the wind's not blowing and at night time, but also at times when there's a lot of air conditioning switched on, so height of summer and early evening or late afternoon when the sun's low in the sky, da di da di da, and electricity prices start jumping up. So again, it kind of has Viura, on the other hand, is a new project that's been bought. It's run into some production problems, but we'll come on to that in a minute. So um, the other part to this is that whilst the existing assets and the existing projects, I mean, this one, for example, has 430 million cubic feet of gas left. Not a vast amount of gas, should we say? But it has an application to drill 5 further gas wells, and these are not deep. The wells wouldn't be deep drilled wells. They're shallow. They are simple. They are relatively cheap to go and do. And they reckon that there's a 75% chance that they'll strike gas, and they estimate an average of about 3.6 billion cubic feet. But overall, there's prospectively 154 billion cubic feet of gas at El Romeral if they can find it. So that's sort of on a what's called a 3U basis. So that's also on an unrisked basis. If you factor in risk and factor in, rather than that number there is the best case, that number there is the low case based on a risked basis. So that one's potentially the more best case, realistic number to be thinking about, whereas that one is the potential, the uppercase potential. As I say, it's got an 8.1 megawatt gas to power generation plant. It's also got a solar array, and it's generating about 4 million euros worth of electricity revenue per year. It's unfortunately, just like this other asset, it's run into problems. The transformer has gone kapow, and this is a replacement transformer, I believe. But what's happening is they are receiving 4,000 euros a day compensation because they've got a service provider that is meant to be that is responsible for the transformer. The supplier has run into problems, so needs to pay a penalty of 4,000 a day. So that's where I'm getting that 1.5 million revenue. But obviously that is coming at no cost, in the sense that obviously there's no production cost as there would be with the 4 million. So it's roughly compensating for the loss of profit until it's sorted. So as at the time of producing this video, which is the 25th of August, it's not been fixed yet. So they're planning on fixing it. There's a couple of other ideas that they've got, as well as the 5 additional wells, that is to build some more solar panels, solar power in a field adjacent to the. So it's presumably this green field over here, or maybe this one over here somewhere adjacent anyway. And you can see, these are the solar panels are on the roof, so they're looking to build some more, because obviously then they could export the electricity from those solar panels to the grid as well, because they've got an existing grid connection. There's also the idea to because if they're successful with all 5 wells, they will actually exceed the capability of this power plant. Obviously, they could upgrade the power plant to produce more electricity, and obviously that would cost some money, but it seems that it would be actually more profitable to export the gas, because they reckon it would cost them about 3 million euros of capex to connect into the grid, but they'd also have to get permission and sign off to tie in the gas, but exporting it would generate about 4 times the money of what they get from electricity on average. But bearing in mind that on average means, on average, so they could even export the gas, but then selectively run the electricity, as a peaker plant. So when there's a shortage of electricity, it's one of those assets that can fire up and burn the gas and produce the electricity. And its capability would be 32 megawatt hours per year. So in a later chart, I sort of talk about what that looks like financially. Moving on, they bought Viura, 7% of Viura, 7.24% Viura in April. The way that that kind of impacts the balance sheet. So one of the things I'd point out here is that the balance sheet. So you're paying 19.7 million pounds for a company that owns investments. Now the investments, this 16.3, is its investment in Viura, okay, which is in producing assets, in Romeral producing assets, and Selva producing assets. So you're buying something that is income producing. These are not exploration assets, and this is kind of where, when we contrast with Chariot, Char, that when you look at their balance sheet and look at their their numbers by comparison, what you're actually paying for. That's just, sorry, I was looking in the notes to the accounts, because one of the questions in my mind was, well, at what point would this potentially get written down? That you're buying, so for your 22 million, okay, you're buying, sorry, that's the income statement. You're buying 58 million of assets. So you're buying them at a vast discount. You're getting 58 million for 22 million, but 56.5 million of that 58.2 million, okay, is exploration and evaluation assets. Now, majority of that, and in the notes down below, 51 million of that is the offshore asset in Morocco. The value of the offshore field, where they had a partnership with Energean. They didn't find what they were expecting to find. It was substandard, and Energean has washed their hands of them and backed out, handed it back over to Chariot. Chariot, in their accounts, this is their 2024 accounts, have decided not to write down the value of the asset. So if you actually take out this, you're actually only left with 1.7 million of assets, net assets, if you don't believe that an offshore exploration asset that a major oil and gas producer has walked away from is not worth anything. They've left it at 56 million. But they do talk about IFRS 6 and the potential for writing it down. And in fact, in the 2024 accounts, if we go and visit that note 11, that we can actually see that in the accounts they do write it down by so they impair it by $5 million. So about 10% of it's been written off, but not the whole thing, not the whole thing. So you've just got to be happy that, but what I'm saying is comparatively, you are buying genuinely, 100% of income producing assets with Prospex, so very different. And here with Mast, as I cover, Uh, oh, excuse me, a bit hay fever. As I cover in this, I mean, you're paying sort of, well, this was back when the share price was much lower. So the NAV of 4.7p, okay, was back when the share price, I think, was nine. Sorry, back was what? Sorry, yeah, it was when it was 49p. So so what I'm saying here is now that that share price has tripled, more than tripled since my article. Uh, you're paying 18 times the net asset value at Mast, which to me is, uh, I think, is insane. But clearly there's this is a kind of a, I suppose, a share where people believe in the story of the 300 megawatts worth of peaker power plants that are going to be built somehow and will generate vast amounts of profits. Plugging the gap in the UK energy requirement, and the fact that they don't have the land, the connections, the grid connections to 300 megawatts worth of energy producing assets, never, nor do they have the capital, and then yes, they do have a partnership with somebody that took 75% of the value of it on the first deal. uh, it to me it's built on hopes and dreams, and that's before we even get into the whole dilution thing that happened here. Whereas in this, we'll come on to the dilution in a minute, but you've got a setup where the owners of the or the directors of the business own about 5% of it, and with options they would get to about 7 or 8% of it, maybe 8% of it, but none of this jiggery pokery with warrants and vast amounts of dilution as has happened at Mast. So yeah, I would certainly, if you like the idea of the energy transition and peaker plants, well, you get that with this, but without the but where you actually own the gas producing asset and the electricity producing asset, um, with cash flow. So it's quite a different proposition, and in my opinion, a superior one. So that's what the balance sheet prospectively looks like, because they spent 4.8 million buying Viura. Their balance sheet at the end of 2024 looked like this. So they had 16 million of assets. So that kind of plus the 4.8 takes them to 21.1. Debtors, I'm kind of assuming the 4.8 came out of reduction of debtors and out of cash. Obviously, in here, I'm not assuming any cash generation from the 2025 operations, but obviously there would be some. So I'm sort of just doing a steady state balance sheet, but to sort of say, you're getting 25.7 million of assets, which, comparing that against the creditors and so on, you've got 24.6 of equity, shareholders equity. So the 25.7 minus 1.1 gets you to 24.6, which, compared to the 19.7 that you'll be paying for this company, you're buying it at a 10% discount rather than a 1,800% surplus, or in the case of Chariot, it's kind of a 55% discount if you believe that the offshore asset is still worth 55 or sorry, 51 million dollars, $51 million. If you believe that that offshore asset is worth zero, and it's or even not worth zero but worth less than 51 million, well, you very quickly get into a position where that paying 22 million for 1.7 million of net assets, well, again, you're paying 1,800% of the net asset value. You're paying 18 times more for the book value of what you're buying, if you disbelieve the offshore assets are worth anything. So obviously you can take your own view on that, but the difference for me is that this is discounts to income producing assets. The offshore, I think the reduced gas find in Morocco for Chariot was I think maybe point 0.7, point 0.7 TCF, 700 BCF. So if you compare that to this to Prospex, you're comparing it against something where, and I've got it listed here. I mean, potentially this is sort of sort of about 4 times larger than Morocco, because they've got Tesorillo that's 2.3 trillion, 2.3 trillion potentially, TCF, 2.3 TCF to trillion cubic feet of gas. And even if you say, well, no, I'm going to sort of go with the low case. Even the low case is on a par with Chariot, but the difference is as well as having the perspective like Chariot does, it's also got income producing assets. So that's a big difference. So that kind of actually covers the next part of this article, which is that it's 0.83 TCF or 830 BCF. If you value that, and I'm not saying this is sort of anything other than just a stab in the dark, but if you value that at €1 per BCF as a valuation, as a discounted valuation, well, even that gets you to 830 million euros, and that is nowhere in the net asset value figure that I've just quoted you. So that 10% discount is going to be a 99.9% discount if that were actually factored into the price of the holding. So nowhere in the share price is that. But of course, there would be a vast amount of development cost to develop Tesorillo. Tesorillo, by the way, is here. So Gibraltar, if you've ever been to Gibraltar, Gibraltar is this bit here, this bit that I'm pointing at with the mouse. Tesorillo is over here. It's sort of to the west of Gibraltar. If you've ever stood on the Rock of Gibraltar and looked out west, you see a mountain. Well, that's what you see there. Behind that mountain, you see from the Rock of Gibraltar, looking out west, is where Tesorillo is. And this red stripe running down here into the ocean, into the North Atlantic, this is the pipeline that joins from Morocco up into Europe. So this is the Trans Maghreb pipeline, I think it's called. Anyway, Tesorillo pretty much runs through that, or the pipeline runs through Tesorillo, is probably more accurate to say. So could you tie in, if you were to discover and develop a trillion cubic feet of gas here, could that be tied in to this pipe? Well, almost certainly yes is the answer. And so again, the development cost, while substantial, would actually be relatively simple. And this is quite I would say a sparsely populated area, so in terms of permitting and things like that, hopefully not too complicated. Having said that, though, I mean, this has been on the books at Prospex for many years and hasn't been developed. So this isn't something where you could sort of say, oh, by 2027 it's going to be an uplift in the valuation. This is a long-term project, I would suggest. But with the need for gas and the need for energy for Europe, could there be support from the EU to support the development of a project like Tesorillo? It's not impossible. They've gone and chucked a load of support into other strategic projects this year. So it's natural gas is no less a strategic asset. I'd argue, potentially more so than some of the other projects where they've classified lithium and tin and other metals as strategic. Energy is just as strategic, in my opinion. And moving on then to Italy. So this is the picture of the Italian asset. So Prospex own 37% of it. It generates about 4 to 5 million euros per year. And judging by the increase, so what I've done is I've taken the increase in valuation as being the operating profit. Potentially, that could be a mixture of operating profit and amendment in fair value, but you've got to start somewhere. So I've used that as the as what the operating cost is. So therefore, to understand, the uplift in valuation, and again, there's potentially 88 billion cubic feet of prospective resources, which risked, sorry, yeah, 37% of which would be 32.6 billion cubic feet to Prospex, who own 37%. And of course, it might be much less than 32, but we know that there's 5 billion cubic feet of reserves and 5 of contingent. So there's, 22 of potential. Then move on to Poland, early stage. So, they're talking in terms of a timeline of 2 to 3 years, application for license areas. Again, this is an early stage asset. It's not a producing asset, far from it. But what they're looking for is proven production. So they're looking to get um, license areas in areas where there are already producing assets, is the key point to say that that there's potential to unlock new reserves. And so it's sort of a relatively low risk approach to be taking. And they've gone through a pre-qualification process, and they've put people in country, so they've invested into the idea of expanding into Poland. And you can sort of see, similarly, really, to its other projects in Italy and Spain. They're looking for low geological risk. They're looking for young reservoirs, so shallow reservoirs. They're looking for countries where there's a favourable um, fiscal structure or regulatory structure to support what they're trying to do. And they also operated the management of Prospex operated in Poland a decade ago, so they've got experience of the country. So timeline. So in terms of the kind of here and now, if we went and looked at the 2024 accounts, which are here, we would not see any sort of vast profits, because what we actually see now, you'll notice other operating income zero. So on first glance, you might look at this and go, flipping heck, this is just losing a load of money. It's not revenue producing. Well, what you've got to realize is that this down here is where the revenue is. This revaluation of assets is the fact that they are operating as an investment company. So in note 12, we'll find those Italian and Spanish producing assets that I've been talking about in the article. And that 713 is like your revenue, or is like your gross profit. It's probably more operating profit, is probably more accurate to describe it as. On top of that, you then have a cost of Prospex itself. So this 1.2 would be the AIM listing fee, it would be the director salaries, and other expenses, but also the expense around Poland, and around developing Poland, around developing its various assets. So we can also see here we've got finance income. So this is kind of a slightly, because this is finance income coming from its holdings. So again, that combined with that is kind of a proxy of the operating income. So we kind of see, overall, it's sort of breaking even in 2024. So not an amazing result. I mean, would you want to pay 20 million to break even? Probably not. So it's all about where it can go from here. So the things that have changed in 2025, or as I record this on the 25th of August, is that they've bought Viura. So let's go back to this. They've bought Viura. So if we go and look at the sort of here and now, the Viura. Now, I'm not saying this EBITDA is going to be the 2025 result. It's not. This is kind of like, once they've sorted out all their short-term problems. So I talked about the mud that's blocking Viura. I've talked about the transformer that's blocking El Romeral. Selva there's nothing blocking that, so that one's producing quite nicely. But you can kind of see that, once the problems are sorted out, and let's say by September roughly, or maybe by October, those problems will be sorted out. So if we say this is a Q4 2025 and onwards EBITDA level, that we're looking at something like a 3.8 million profit level. Okay, and that's kind of taking into that's EBIT, so that's not taking into account all of the costs we saw a moment ago. So it's not taking into account that cost and that cost. We'll need to come back to that. But what we are seeing is something like a 3.3 million EBIT at these production levels and operating profit levels. So you kind of see a business that today on a run rate going forwards is on something like a 12 times, okay, 12 times earnings. So again, not vastly attractive where you'd sort of want to run out and buy it, soon as possible, but not, it is cash generative, it is profitable. That 1.7 that I'm arriving at is I'm taking the overhead costs at the PLC, the tax, to kind of arrive at a 1.66 net profit. So it's around 1.7, 12 times, 11.9 times. So that's kind of the here and now, more or less. But what we've then got to consider is that obviously they've got cash and they've got plans. So the plans are, as you can see here, is to drill El Romeral, to do workovers at Viura, to drill 1 to 2 wells at Viura, at Selva, 4 wells to drill those. And so there's plans to change things. So so if we sort of consider each one of these one by one, I mean, El Romeral, there is a limit to how much electricity can be produced from the gas to power plant. So 32 gigawatt hours. Basically, if all 5 wells come in with 100% success, which is unlikely because it's 75% average chance of success. But let's say they did, what they would find is that they had probably 4 to 5 times more gas than they could actually burn at the gas to power plant. So it's at that point that you would sort of then say, well, okay, you've got the gas, you've got the gas production, but you've got to find a home for that gas. And it's at that point that you would definitely want to connect it into the grid, and export the gas directly rather than produce electricity pretty much all of the time, because the revenue from selling the gas to the grid is far higher than the electricity you get from selling electricity to the electricity grid. But of course, you would continue to sell the solar energy because that's obviously the case. And there's a kind of break even of about 300 euros per megawatt hour. So in other words, once you could export the gas to the gas grid, you would just do that. You wouldn't do anything else. And then but of course, you'd have the upside that if there's a windless night and electricity prices shoot up beyond or at or around 300, well, you could switch on your electricity production facility, your gas to power generator, and sell electricity pretty quickly to meet that demand. So what I'm saying is, if we take this, let's just widen that out a little bit. If we take the upside of the projects that are chalked in for the next 12 to 24 months, drilling, during 2026. So sort of, 12 next 12 months really, that what we can see is, I mean, yes, there's a lot of capex cost behind that. So, you know, 20 million is a chunky sum to find. But and this is based upon 100% success. So I'm saying, if all of these campaigns were 100% successful, what that would generate per quarter, and these are estimates based upon the assumptions being made by Prospex themselves, and notice I'm using sort of 52 euros, 56 euros. So I'm using a lower rate than 2024, where where's my 2024 gone? There we go, 61 and 56. So I've kind of assumed, future prices are lower. This is the electricity. So if they were exporting, the maximum electricity, 32 gigawatt hours, that would be 8,000 megawatt hours per quarter. And that would sort of generate zero point 0.8 million, 0.9 million euros per year. A bit. If they were able to export the gas, I mean, it would quadruple to over 4 million profit. Bit per year. So sorry, 16, because it would be 4 per quarter, 16. So it's vastly more profitable to sell the gas than to sell the electricity, and that's because you could only sell a slice of the power, because the capacity of this is constrained. So what I've done to get to this number here is I've actually just ignored the electricity production. I'm assuming that would be zero in the case that El Romeral is going to spend the extra 3 million euros to connect itself in to the gas grid. So the 5 well campaign would be 11.5 million to do the drilling, and then to do the tiebacks from the drill to back to the back to the power plant, and then a further 3 million to connect it into the gas grid. We've then got Viura, where I'm kind of taking 2.9, and this is for 1 or 2 wells, and that has the potential to boost production by 55,000 barrels of oil. I've turned everything into barrels of oil equivalent. That's how my brain works, and that sort of gives me a more broadly comparable number to work with. All I'm doing though is I'm taking the SCM per day, which is standard cubic meters of gas, and just converting it using a conversion to turn it into barrels of oil. So so that would generate an upside of 55, which would generate which would give us about 9 million, 9 million a bit per year. Selva, again, there's a 3.3 million cost to 4 new wells, and this is based upon the share of the cost, based upon how much Prospex owns of these projects. But that would prospectively generate a further 2 million per quarter. So that kind of those three prospectively would generate 8 million per quarter, which is 32 million a year EBITDA. So this is additional EBITDA to the existing EBITDA, that even if we sort of assume, yes, there's going to be some extra overheads involved and depreciation involved, and tax and so on, and maybe some interest costs of borrowing money to pay for that 20 million of capex, you're still looking at something like a 17 million 17 million euro net profit. Now that, which of course is not million pounds, it's euros, but that kind of translates to just over 1 times the market cap. I mean, that is massive difference. Now, you know, obviously they've got the challenge of finding the money to pay for that capex, or they do it incrementally, bit by bit, based upon the cash flow that we talked about up here, where they are generating something like 4 million, 4 million cash, 4 million euros of cash per year, or a million of euros per quarter, based upon what they've got today. Now the El Romeral, as I said, that's probably the first one to go, because they've only got that 600 million of cubic feet of gas left in their existing wells, so they would want to probably focus on El Romeral first. But obviously some of it depends on when they get sign off on projects. The Italians are notoriously slow at signing things off. Although it's interesting, in the 2024 accounts, they do talk about a new scheme and a transformation, and how things have been sped up. And I don't know if I'll be able to find it, but it's something. There's some funny acronym that a new program to fast track production in Italy. So there's yeah, I think it's under this section if I remember that. Yeah, they've got yeah, they've obviously got to get agreements with local landowners and the permitting process with the regulatory authorities. And it's this thing here that you can tell why I couldn't remember it. PXEN. So there's the Italian authorities have lifted exploration and extraction restrictions under the Plan for Sustainable Energy Transition of eligible areas. This was confirmed in 2024. So that means that activities may now be no longer required highly deviated wells, reduce risk, reduce cost, improve regulatory environment, geopolitical landscape, and obviously that a lot of that is going to be down to the new prime minister there, um, Giorgia Meloni, and her pro-business approach that probably is a little bit of cut through the nonsense and so on. So yeah, as I say, I mean, when you kind of look at this and look at the um, like this kind of summarizes it now here that yes, it's on a price earnings of zero. If you look at the 2024 accounts, it's on a price earnings of about 12 times. If you look at the kind of 25, 26 accounts, which obviously you can't look at because they haven't been produced yet. But based upon my estimates, if you believe and agree with my estimates, you're kind of buying a business that's got a 12 times earnings, but it is producing. It's producing, it's got real assets, it could sell those assets. They are sort of producing assets. So they feel quite different to an offshore deep water gas that Energean has walked away from, that there's no news flow from for what best part of a year. Very different to Chariot. As for these folks with their massive amounts of dilution, and they don't own a single piece of gas production, they just are going to be buying in the gas, buying in land to produce. They've got one project I think called Bordersley, no, sorry, Hindlip. Sorry, apologies, Hindlip. That they actually own the land, and it is construction ready. They've got another one that they are refurbing, but everything beyond that, like this 300 megawatts of gas peaker plants that they're going to be producing loads of profits from. Well, they don't own the land, they haven't got the connections, they haven't got timescales on the connections. There's a whole just raft of things that are sort of just mental. So when I looked at this and it was 6 times the NAV, and now the price has tripled since I wrote my critical article, and it's now 9 times, or sorry, 18 times the NAV. I mean, it just baffles me anyway. Uh, that's just my opinion, but that's looking at the numbers and looking at what I believe could be the potential and the sort of upside potential. Because obviously, if everything went their way, and if they were able to extract the high case at every one of their projects, and I'm assuming nothing for Poland in this, but if they could extract 2.3 TCF of gas from Tesorillo, that would equate to, and I'm using the same, per barrel of oil equivalent number to kind of get to these numbers. So 56 euros per barrel of oil equivalent. That is worth, in terms of revenue, is 22.8 billion revenue of gas, which at a sort of an assumed profit margin of about 60% would be worth something in the region of 13 million EBITDA or EBIT. Potentially, they wouldn't see that as pure profit, that there would be tax and there'd be development costs and so on. However, that kind of comes to 14.7 billion euros of potential earnings, and obviously that's undiscounted earnings that I'm talking about there as well. I'm not putting any kind of NPV10 over that, because I don't know what timescale I'd be able to put that over. You know, if I put it over 20 years, maybe 14.7 billion discounted, you're still looking at something in the region of 3 to 4 billion at least, depending on the discount rate and other factors, the length of time. But vastly higher than 20 million market cap, vastly higher. So, because Tesorillo is a very early stage, you could even just strip that out and say, well, just ignore that. Even for the rest, you're still looking at 1 billion of earnings, of EBITDA earnings, that are relatively near term. I mean, even if you put a discount rate over them, you're still looking at an upside of several times to say today's share price, as far as I can see. And I suppose the macro behind this, I mean, obviously you've got management that own part of the business, so you've got alignment there. You've got the macro that's, I think, positive, that it's not as though there are vast amounts of European gas being developed anywhere, particularly that, I mean, apart from Norway, I guess you could say, but in Southern Europe, there's imports from North Africa, there's imports from the US, imports from the Middle East. If you believe that we'll make peace with Russia and that Russian gas will flow again, and obviously Prospex is probably due to go to the rubbish tip. But if you don't believe that will be the case, or at least won't be the case for any time in the foreseeable future, then there's an opportunity for Prospex with supportive gas prices, potential for strategic support from European governments or from the EU, and that the alternatives are all expensive and unreliable. That North Africa isn't a panacea for European gas. Uh, US LNG gas, I should probably put LNG there. I mean, obviously that comes at a cost, a transportation cost. So yeah, I mean, I think Prospex looks very, very interesting, and certainly when you compare it against similar companies, I think you can just sort of say it stands head and shoulders above them, in my opinion. But I've given you the metrics by which you can make your own decision on that. I mean, if you said, well, no, I believe that offshore gas is worth every penny of the exploration cost, then yeah, I mean, potentially, if they can obviously turn that into production faster than Prospex can turn its shallow onshore gas into production, then Chariot would be worth more than Prospex. But it hasn't happened yet. So yeah, I think it's just kind of thinking about that one a little bit, and similarly with these guys, that yeah, you've just got to sort of, whether you believe the 300 megawatts expansion can happen, and as profitably as that would justify its rapid increase in share price. So anyway, that's everything that I intended to cover. This idea will be published in the next couple of days, so you've heard it here first, lucky people. And look out for more videos coming soon from the Oak Bloke. Cheerio for now. Cheerio.